SpaceX is gearing up for an IPO with an expected valuation between $1.75 and $2 trillion. The listed entity acts as a massive mega conglomerate, merging traditional launch services with the Starlink satellite network and XAI, the artificial intelligence division running Grok. A successful $2 trillion valuation instantly makes SpaceX the sixth largest publicly traded company in the world, eclipsing the previous market record set by Saudi Aramco. But there is a major logistical roadblock. You cannot open a brokerage account and buy SpaceX stock today because there is no publicly available ticker. Because of this lockout, eager retail capital is aggressively spilling into the next best options. Money is flooding into sector proxies, supply chain components, and competing launch providers. This environment creates a highly dangerous landscape. Without a direct way to invest, retail buyers are trading entirely on excitement, often ignoring the severe structural risks. Even when the actual IPO finally materializes, you have to look closely at the corporate governance structure you are buying into. Elon Musk will retain 85.1% of the voting power. He will maintain near total control over the mega entity's direction. This chart shows how that works through a dual-class share structure. Your common public shares capture the financial upside, but they hold zero voting leverage compared to the super voting blocks held by insiders. Buying into this IPO means executing a very specific trade. You are providing capital for financial exposure, and in exchange, you surrender all influence over company operations or XAI integration. If you refuse to wait for the IPO, your first alternative path is buying pre-IPO proxies, like the Destiny Tech 100 Fund or the Scottish Mortgage Investment Trust. These are publicly traded vehicles that hold private shares of SpaceX in their portfolios, effectively acting as a backdoor for retail money. This quadrant chart maps the risk. We track proximity to SpaceX vertically and valuation horizontally. Destiny sits high on proximity, but deep in negative valuation territory. This gap represents a massive NAV premium. Buyers mathematically pay much more than the private shares are worth. Alphabet presents a safer proxy route. Following the XAI merger, Google's early investments have translated into an estimated 5% stake in the combined mega entity. The trade-off here is scale. Alphabet is relatively stable, but any upside from its SpaceX holdings will be heavily diluted by the sheer size of Google's core advertising business. Pre-IPO proxies force a direct compromise. You pay an irrational markup for concentrated exposure, or accept severe dilution hiding inside a tech giant's balance sheet. The second path is to buy direct public competitors. The clearest comparable company on the market right now is Rocket Lab. They offer overlapping capabilities across launch services and spacecraft manufacturing, and they have a proven track record of delivering payloads to orbit. Looking back at our quadrant chart, Rocket Lab sits firmly on the healthy side of the valuation axis. They are currently benefiting heavily from a halo effect, where the market is aggressively repricing the entire space sector upward, purely based on the SpaceX IPO news. The core risk with this path is operational reality. Rocket Lab is a smaller competitor that still has to execute its contracts and survive alongside an industry monopoly. Buying peers offers a fair market valuation, but requires betting that a smaller player can withstand the heavy gravitational pull of the SpaceX operation. The third path looks past the launch pad entirely. The modern space economy requires an immense amount of physical hardware and infrastructure. Companies like Redwire operate as pure-play options, focused entirely on satellite infrastructure and manufacturing spacecraft components. Then there is Intuitive Machines, an infrastructure play focused heavily on the emerging lunar economy and building landing systems. These picks and shovels companies carry highly specific operational risks. Their revenue is heavily reliant on complex, fixed national security and government contracts. The final path is the basket approach, using space-themed ETFs like UFO or tickers like Mars and the Warp Fund. The major drawback to these funds is structural. To fill out a complete portfolio, managers often include legacy aerospace and defense stocks, which dilutes your exposure to pure space tech innovation. Casting a wide net with ETFs or supply chains will protect you from the financial shock of a single rocket failure, but that safety severely limits your access to the explosive upside of the industry's actual growth. Because retail capital is locked out, there is no perfect one-to-one method for buying SpaceX right now without accepting serious compromises. This decision tree shows how to map your capital to your specific investor profile, starting with one question: what is your primary goal? If you are driven by direct exposure and must own a piece of SpaceX today, avoid the Destiny Tech 100 fund unless you explicitly accept the mathematical penalty of its massive NAV premium. The Google route offers a much safer harbor for indirect ownership. For the conservative allocator, Scottish Mortgage, Alphabet, or broad ETFs provide stable, diluted thematic exposure without forcing you to overpay for the underlying assets. If you are a sector strategist looking to capitalize on the halo effect, you should look toward Rocket Lab or infrastructure plays like Redwire and Intuitive Machines. Capital should never chase hype. It must be assigned to the specific financial vehicle that matches your exact risk tolerance and timeline. The modern space economy is a massive, interconnected infrastructure network. It extends far beyond the launch of one dominant rocket. Sitting in cash and simply waiting for the actual IPO to list on the New York Stock Exchange is a highly strategic decision. When that day comes, remember the terms of the deal. Buying the IPO gives you absolute financial exposure to the company with absolutely zero influence over how it operates. Do not let the excitement of an incoming $2 trillion valuation blind the basic financial math of your portfolio. The space race is officially here, but surviving the rush requires treating proximity, premium, and patience as your true investment metrics.